Good morning, dear students. We were doing financial management chapter. In this chapter, some more practical questions can come. So, in this lecture, we will discuss few of them. Like for example, in question, they may ask you to calculate net working capital. So, what is a formula to calculate net working capital? That is current assets minus current liabilities. So maybe some assets and liabilities are given. So you should know what are current assets and what are current liabilities. I hope you have done in your accountancy also. So you will just add all the current assets and current liabilities, and then you will minus them. From current assets, you will deduct current liabilities, and this will be your net working capital. So such type of questions can be asked in 1 mark also. Then another question is debt service coverage ratio. Basically, this ratio will tell you how much more debts can be added in your capital. So better the ratio, better will be the ability to pay cash commitments. So we will be able to add more debts in our capital structure if this ratio is better. So this is a formula: net operating income divided by total debt service. This is extracted formula like profit after tax plus depreciation plus interest plus non-cash expenses, preference dividend also plus interest plus repayment of obligation. So this will be divided by this. So for example, in the question it is given that net profit is 1,50,000 and interest, this is your expenditure. So that is 55,000, and principal payment, any payment is due, that is 35,000. Sinking fund obligation 25,000. So for example, this is given, then you have net profit of 1,50,000. This will be divided by all the debts, means whatever debts service you are paying. So you are paying 55,000 as interest, plus any payment is due 35,000 and sinking fund obligation. So this ratio will be calculated in this way. So you can see 1.3 is the answer. So this is debt service coverage ratio. So this ratio will tell you how much capable you are to pay the cash commitments. Another question can be asked to calculate return on investment. As I told you, return on investment will tell you how much capable of. These all are related with that you should add debts or equity in your capital structure. So return on investment should always be better than the interest paid. Whatever interest you are paying, it should be better. For example, this is a formula: earning before interest and tax divided by total investment multiplied by 100. So earning before interest and tax is given 4 lakh, investment 45 lakh, and if you are issuing shares then 10 rupees, interest is 10%. So this will be the formula to calculate 4 lakh divided by 45,000 multiplied by 100. This is 8.8%. So it means that your interest is 10%. If you are paying 10%, if you are borrowing debts, then it is 10%. Means this ratio is not good. You should not go for debts, because return on investment should always be better than the interest which you are paying. Then there is one more thing which can be asked, that is ICR, that is interest coverage ratio. Interest coverage ratio's formula is earning before interest and tax divided by interest. So earning before interest and tax is already given in the question, that is 4 lakh, and interest which you are paying is 1,50,000. Sorry, this is 1,50,000. One more zero by mistake is added. So when you will calculate this will come to 2.6 times. So this will tell you that how much capable you are of paying the interest on the debts. Basically, all these things we do, all these ratios are calculated to know that how much capable you are to add debts in your capital structure.